Louise Bedford here, your host of the Talking Trading podcast. I'm the Money Chick and I'm going to show you where the money is in today's market. Now, I don't know about you, but I'm a property investor as well as a share trader. And in fact, our best share traders in my mentor program come from the property market. The thing is, lately, I have to admit, my property investing has gone to the crapper. So, is the property market actually in the crapper, or are there hidden pockets of money to be made? To help me answer this question, I've turned to my friend Brendan Kelly. Brendan and I have known each other for the last 20 years or so, and I have to say he has been an absolute life force in the property market, helping people get the education that they need to be able to create a passive income. Now, Brendan's also the co-author of The Real Deal, Property Invest Your Way to Financial Freedom. He has got over 30 years investment experience and he runs his own mentoring program. Brendan Kelly, welcome to the show. First question, do you think that property has really gone to the crapper?
No, property's never going to go to the crapper. People must live in houses. There is always going to be people moving around the country, always people growing into different phases of life. No, the property will never go to the crapper. But again, what's the crapper? Are you talking about a 40% drop in values? Because there's a gentleman out there who regularly goes, we're going to fall by 40%. Not going to happen. So we just have a conversation of supply and demand, economics 101. It works. So no, hasn't gone to crapper. Phases, of course, but you'd be familiar with phases. As a trading expert, you would be identifying those waves that work in Australia differently to America, the waves that work in certain stocks versus not stocks. You know, you would have seen all that, yeah? Well, it's the same sort of thing in property. No, not going to the crapper.
And maybe that's why as well, my traders in my mentor program that do the best are often the ones who have had more than just trading as their background. A lot of my best traders are from the property side. That mindset seems to translate. You know what I liked as well? The other day when we caught up, you were talking about that there were some individual areas that were going very, very well. What have you got for us here? I mean, surely there's some hot spots you can talk about.
Well, I do have a report if anybody wants it. What we're offering is people to access a report. It is the top 10 suburbs. All you need to do is just go to resultsmentoring.com/hot10, register, and the report will be yours immediately. You'll also get an opportunity to talk to a mentor, a property investing mentor. Quite a valuable sort of thing to do. Actually, if you've never spoken to a mentor on property before, there's a certain value that they bring to the conversation as a reflection of your activity and what you want to achieve. So if you wanted to, when you register for the suburb report, you'll get a one-on-one strategy session. Cool. Around the country, though, there are different things. People are doing different things at different times, yeah? And what we're finding is that some suburbs are not doing so well, some areas are not doing so great, some areas are doing much better. Do you want me to do that now? Are you happy to go through that now? Is that what you're thinking about? All right, great. So let's go around the country and figure out what's happening around the country. Basically, where we are right now, I've built a company called Property Predictions. Property Predictions is an organisation that takes into consideration all the data that's available around the country for property, interprets that data, where the market's going, relatively accurate. Upshot though, we are seeing that the current market across the country right now is in decline. Nominally, but in decline. There are more stressed suburbs and buyer suburbs in the country than there are boom suburbs and seller suburbs in the country. So consequently, the market is heading down. However, the market is moving to a position of growth later 2025. Not significant growth. It's not going to be the flames of glory that 2021 was, but we will be seeing growth. So we've got much fewer stressed suburbs, fewer buyer suburbs, more seller suburbs, more boom suburbs, and a similar number of neutral suburbs. So what does that mean for the market and what's it going to look like? If we have a look at the again, CoreLogic put out a a series of data points around the 5 capital cities. If we look at the what's occurred since 2013, you've seen a spike in activity. 2017, APRA came in, said, no, we don't like this. Too many investors, not enough owner-occupiers on borrowing money. Came down, we had an election, went up, went well. That was when the pandemic hit, went down, bottomed out in the pandemic. You'd be familiar with the pandemic.
The plague.
May have experienced it. Yeah, very personal thing it was. Anyway, we had the explosion post-pandemic. We had interest rate corrections coming back down. Then we've gone, oh, no, I think I can tolerate those interest rates. And then we've gone, well, maybe I can't. We've plateaued here. So we are at a point where the country broadly, although as you've seen by the number of suburbs doing various things around the country, very, very different activity. But as an aggregate, we've plateaued out and we started to come back. That decline will continue, mostly driven by Melbourne, partially by Sydney, and as the other states plateau out. But we will pick up at the back end of this year as interest rates do come down. They won't come down a lot, but it'll be enough to take the edge off and enough to be able to inspire people to go, actually, I think I can afford to move now. I can afford to buy a bigger house and stick my teenage kids out the back somewhere where I don't have to deal with them. Or I can afford to move out of our 1-bedroom or 2-bedroom apartment with my 2 little ankle biters that are actually sending me around the bend right now. We'll get a bigger house. So there'll be an opportunity for people to move short.
That's a lovely thing. I think also with that is that it's important to know that there are times that will be brilliant in any investment opportunity and times where there will be a bit more of a plateau. So these things are to be expected, same as in the share market. You can't always have things going boom times. Things do need to consolidate and stop for a bit of a rest.
They do. And that's what we're seeing right now, although in varying degrees depending upon the city you're looking at. So what I'll do is I'll just quickly go around the country and before we do, I'll have a look at, and we'll do country versus city, because while these are city statistics, doesn't represent the entire country. It's pretty close though. So national versus regional, what we've got is combined capitals coming down to a slightly negative rate of growth right now. And regions, however, across the country are holding out firm. Now, notice there is a lag time. Generally speaking, country lags after city. It's a city that drives price. If we look at Darwin, for example, Darwin's flat, some volatility up and down, a couple of percentage points, but under 5, and it's still plateauing out. It'll stay flat. There's no inspiration up or down either way. Hobart, for example, that's been more flat. So that's been flat for about two years, 18 months. Nothing's going to change in Hobart. No, there's no population growth over there that's going to inspire any magic lift in price. It's going to be a relatively flat market there. Canberra, also relatively flat. So the smaller cities are just flat. There's just long-term flat activity. If we go to Perth, however, I'm just going to hide that. If we go to Perth, however, we have seen significant growth until recently. Recently, we've seen it plateau out. So from around about mid-year, it started to come back, and that plateau will continue. If we have a look at city versus region in WA, you've seen a decline in buying activity already. The change in the sentiment of the market is stepping back to a more neutral environment, and that trend will continue, both regionally and in the city. If we have a look at Adelaide's had a fairly steady rate of growth, plateaued out a little more recently. That will continue to plateau out over time. Seems to be a slower rate of plateauing, but it is plateauing out. If we have a look at the city versus region, you can see that it's calmed down in the city, which is the orange line. Blue line capitals, we're kind of still flat, but that will likely follow suit shortly. Brisbane's already started to flatten out. About 3-4 months ago, it started to really plateau out a bit. There was some significant growth for a long period of time, which a lot of people enjoyed immensely. It will continue to plateau out, and towards the back end of 25, you'll see it left again on the back of the interest rate drops that are pending. If we look regionally and city are both heading back at the moment and at about the same rate. So there's not a too disparate environment happening between region and city. Melbourne, however, Melbourne is in decline and has been in decline for a good 6 months. It's hard in Melbourne. There is developers are finding it particularly difficult to sell. Off the plan sales are not occurring. It's just a tougher environment in Melbourne right now, and that's on the back of a lot of property investors in Melbourne not wanting to stay in Melbourne because of the changes of tenancies and interest rates, etc. So, but that again will shift towards the back end of this year. People will come out of the woodwork and go, oh, okay, great. I have a confidence now to be able to say I can afford what I'm looking to go into. My lifestyle will manage the upgrade in living, and we'll be able to. You'll see a lift in that, but not a lot, nominal. City versus region, Melbourne is in decline. Regions seem to be holding a little less miserably than Melbourne is right now, but that's temporary. Sydney is also in decline, and that'll follow a similar path to Melbourne, albeit condensed. You'll see a continued decline for a period of time, but it will lift again in the not too distant future towards the back end of 2025. Regionally, it's holding out, but the city itself is coming down. So that's kind of where we're at with respect to around the country. You're looking for pockets. Where would you go as a pocket? Depends entirely on what you want to do. For people who are into property and are into active property, meaning the so we can stop share now, meaning the people who do renovation, subdivision developments, what's working in those states where there's still a bit of heat is short-term projects. Get in, do something, get out, make money quickly. So there's a lot of renovation activity right now. Buy, reno, sell, buy, add value, sell, and short-term projects, simple subdivisions, 1 into 2, 1 into 2 in the more affluent areas, and people are making money. The long-term buy and hold people, if they buy and have bought in those states, Brisbane, Perth, Adelaide, then they would be just counting their money all the way to the bank. Their accountants would be very, very happy with them. Things are looking pretty great. As I said, a lot of buy and hold investors have exited Melbourne now. Few are more nervous about investing in Sydney at the moment. But again, it will plateau. And so then if you go to the never sell model, buy, hold, never sell, there will be a period of time where people are going to need to go, I'm not experiencing much growth, and have to suck it up. But as you know, it goes in waves.
Yes, it does. Do you know, though, in my quest to show people where is the money, you have answered that question so beautifully, Brendan. You're a superstar. This is why I adore it when I run into you on the street and pepper you with questions about the property market.
Happy to help.
But I have to say, there are a load of people who want to retire on, say, $100,000 a year. They are hoping for it to be passive. They've spent a long time working, and it's been so hard to be able to scrape together the money and the assets to be able to retire. All they want to do is get a bit of payback. Now, is this a feasible dream with property? Can you retire on $100,000 a year through passive income using property as a vehicle?
Can you do it in shares?
You can, but you still do need to monitor things. I am personally, I don't know where you stand on this because we've never discussed this, but I don't think there is a passive income source unless you've been left a massive chunk of money from some sort of inheritance. Good luck to you if you happened to land in the right family. But with property, can you do this completely passively?
All right. First, I want to identify what the word passive actually means as a concept. Yeah. No investment in any circumstance, even with inheritance, is passive. Yeah. There is going to be a requirement for maintenance in some shape or form. All right, great. Your job in wanting to live a passive income existence is to minimize the amount of effort you have to put in to maintain your cash flow. Right. So If you're doing active property strategies, well, then you've got yourself a job. You're running a business. Yeah, you're always searching for properties. You're always looking for the next deal. You're buying to the next deal. You're executing the project. You're ending the project. You're selling the project. You're buying the next one. You're running a property entrepreneurial business. Brilliant. But if you're looking to sit on the beach and sip pina coladas, then that's not the way to go. Passive, my experience around the most passive form of income comes from buying commercially held properties. So you go and buy places like warehouses, small warehousettes. Perhaps not so much retail, they're shorter lease periods. Medical is good. So if you're going down the path of I'm looking to retire in the next 2 to 5 years and I have an abundance of equity, but it's not returning me a lot right now. Because, for example, if you'll do a buy residential investor doing buy, hold, never sell, you'll find that you'll have a massive portfolio yielding a very small income. Because in cities, return on investments in the 2 to 5% range, depending upon the nature of the market. What we want is higher yields and less input on our part, and commercial properties are the way to go. So 2 to 5 years before you pull the trigger to retire, your primary objective would be to shift your thinking, grow your wisdom towards moving the equity that you've accumulated over the years into buy and hold commercial properties with long leases and stable tenants. If you can do that, you then have, in my mind, the most passive form of reliable income, other than a managed fund or something, or an annuity where you don't touch it and there's just a mass of money and somebody else manages it for you and you just pay fees, shut up and move on. So if you want to be in control of your own asset base, then commercial property is the way to do it, I say. If you want to live an incredibly passive existence and you're happy to let somebody else manage your money for you, then go into a managed fund or an annuity of some form. I'm not a financial advisor. I don't have your license, Louise. So don't quote me on that, and go and find your own due diligence. Do your own due diligence. Find your own financial advisor. I'm not the guy, but my experience is that would be the way to go.
Yeah, I like that. And this is where we do need to rely on people who've had more experience in the market, because it can take a lot of time and a lot of money to find your own solutions. By the time you've developed the wherewithal to be able to make this type of decision, how much money have you thrown down the drain experimenting? I always find it's easier to ask people who've been there and done that.
I'm going to interject for a second, just for a thought. If you think education and support is expensive, try ignorance.
Ooh, I like that. I like that a lot. Yeah, I think a lot of people have been thrown around by the inflation and the interest rate and the cost of living issue, where we're seeing a lot of broad angst. People are finding this is something they haven't faced before, and they're almost running out of cognitive bandwidth to be able to handle this. What are your thoughts on this, and how can traders and investors adapt to new situations like this?
I don't think this is a new situation. People have been here before. It's just if you've not experienced before, yes, I get it, it's new. People are feeling it. If you go to the ABS and you do, they offer a chart pack, free chart pack. If you download the chart pack from the ABS, and I don't have a slide for it today, but there's a graph they produced which compares disposable income with how much you need to spend on living a life and how much anyway, it's a graph of some sorts. Description fails me. Upshot. We have seen an event recently during the pandemic where we had a whole pile of money thrown at us and nowhere to spend it. We had savings that were huge, which was great. As soon as we were allowed out of our houses again, we spent that money, and we spent big on retail, which caused the inflation and sent us down into the inflationary spiral. Great. We had to pull the reins in a little bit, and they used interest rates to do so. Fantastic. Thanks for sharing. Really needed that help. Not. Anyway, the RBA pulled in the interest rates, lifted them, made it harder. Cool. And what that's caused us to do is to spend that money that we've saved in order to survive. So we were living in a credit environment. We were living beyond our means for a period. Only recently have we just come back and stopped living in that place. We have now started to experience a little bit of disposable income, and we are now starting to save a little bit again. Any money that is coming in is going towards the coffers for savings, so we're not spending it so much. So there's a wisdom around it. The belts are as tight as they can go. And while we're not going to get an interest rate lift, fantastic, because that would send us over the edge. We're at a place right now where, as much as I hear people say, we're expecting something very shortly in a interest rate cut, I'm thinking the odds are not there yet. No. There's still a suck it and see environment. The per capita position that we're in, per capita, we are in recessionary environment, but as a nation, we're not. Meaning our population has grown. Because of our population growth, we're spending. Based on that, the aggregated sense is that we're not actually in a nationally negative environment, but in our individual household, it's been measured that we are. We are spending more than we're earning. We're doing it tough. We're not living on I feel it anymore. We're living on baked beans on toast, but we're living. Yeah. So the point there is we have pretty much sucked it up as hard as we can go. We're not going to go any further, which is great. And soon we'll be okay to experience some relief. I think my read is the RBA is unlikely to do that in February. There's still going to be a watch and wait. I don't think that nobody wants us to go into a recession, and both the political parties and the RBA want a badge on their chest to say, look, we fixed the economy without going into a recession. Now, we didn't need stimulus and massive stimulus to recover from the overcorrection. So they'll be very proud of that, and they're watching very tightly so that they don't go down that far. And it's going to be just tweaking. Have you ever reversed a trailer in a car?
Oh, badly, yes.
Yeah. If you oversteer, the trailer just goes wherever it wants to, yeah? So the RBA is just, when I'm not going to oversteer, I don't want to send this trailer down the wrong path, so I'm going to have to go forward and do it again. Yeah. What I want to do is just tweak the steering wheel a little bit. And if it's going straight or straight enough, I won't need to tweak. And I reckon that the economy right now is going exactly where they want it to be. There's no need to tweak. I don't think anything's going to happen in the next month.
Do you know what, though? I think people overlook opportunity in this environment because it's almost like you've got those blinkers on and your focal range is narrowed and narrowed and narrowed until you think, oh my gosh, it's just me and I'm having to survive and my family is at risk. Do you know what the opportunity is? It's to look to see what can the year ahead bring? Where are the opportunities lying? If you can actually get your mindset out of the gutter while everybody else is on a downward spiral, you'll find that there are incredible opportunities ahead of you. The majority of multimillionaires of the years gone by emerged after a recession. That is fact. So can you use that in your own way to harness the strength within and to look for opportunities while everybody else is shutting down? Can you look up and see what is available? I do think people make mistakes. That is one of the common mistakes that people make. They feel that the economy is their economy. And that translation, I think, can be very dangerous. Brendan, what do you think are some of the other common mistakes that people make with investing and maybe even in the property market?
Ignorance.
Yes.
Ignorance.
Yes.
It is, okay, so I'm going to call it ready, fire, aim. Yeah. A lot of people start their property investing journey with, I think I'm going to go and buy a property. Who do I talk to? I'll go to the bank to see if I can borrow money. They said I can. Mortgage broker said I can. Who do I talk to now? Real estate agents. What's on the market? Cool. So they just jump on realestate.com.au. They go for a watch. They look at what's available on the market. It's not far from where I live. I can do a drive-by. I can see it. Open for inspections. Real estate agents are broadly lovely people. So and they're already always generally buoyant and happy to see me. So it's a lovely, warm environment. And you know what? I think I'll buy something. And then what do I do with it now? Yeah. Ready, fire, aim. How do I make money out of it? I've got it. What do I do? How do I improve it? Whereas the far more effective way is to learn first about what it is you want, where you want, what you want your property to do. The number of people who buy property without knowing what they want to get from it is phenomenal. If you did it the other way around, what do I want to get from the asset that I'm going to buy? What do I want to earn from this asset? Am I going to get the income that I want from it if it's income I'm after? Am I going to get the growth from it that I want if it's growth that I'm after? What am I going to get out of it? And on the basis of me knowing what I'm going to get out of it, where do I go and find this thing? Ready, aim, fire. So the ready, fire, aim approach is probably one of the biggest problems that we see when we're mentoring and supporting people. You can buy properties in areas that don't yield an outcome that you want in growth or in rental income and wonder, why have I done this? It's a forced saving exercise with a 0% interest rate growth. I mean, it's a hard way to go. Or, again, shoot at a dartboard and hope and pray. And if you happen to land on a bullseye, great, you get a win with both rent growth and rent price. But it's more luck than good management. The second thing about that is arrogance. If it works out that, oh, look, I had this win, fantastic, I'll just go and do it again, then you have a greater sense of risk about you, because not only did you fluke the first one, you think you're great at it, and you're going out again and you put yourself at more risk for the second one for a bigger fall. So generally, yes, you want to learn before pulling the trigger on anything. Just with you, Louise, if you're not going to go and encourage people to go, oh, just pick anything in the 500 and that's it, you'll be right. It's not, you're not going to teach that. You're going to tell people, all right, you've got to look at the fundamentals. You've got to look at what the shares are doing. You've got to look at the process that you're applying to this and understand that process. Then paper trade, practice, get some skills in it, apply your wisdom to the market broadly on paper. Then when you're ready, by all means, pull the trigger on it because you're skilled at it by now. Yeah, we're anticipating. We encourage similar. Do some paper trading on some pretend deals first and see how they go. Another one that I find is you kind of call it analysis paralysis.
Oh yeah.
It's the, I don't know what the market's doing. I don't know what the market's doing. You know what? It's going up. It's going up. No, it's too late. I won't get in now. And then it's plotted out. Oh, I've missed it. I'll wait until it goes up again. And then it starts to go up and you go, I don't think it's really going up and it's not really going up enough yet. You know what? I'll wait until there's real evidence it's going up. Oh, it's too late. I'll wait until it plateaus again. And they just never take any action because it's never the right time.
They've given themselves entertainment, and it depends what you're investing for. Like, to me, that is why a lot of share traders have difficulties, because they love that dopamine rush, that feeling that, oh, I nearly got it, that near miss psychology. And in actual fact, we know that that's not the best way. Everything you're saying, you're applying to the property market, but I'm applying to the share market.
Yeah.
Those skills are exactly the same. You know what I think as well, Brendan? I think it's because people are time poor. People are running around so busy trying to look after their families and look after their elderly parents. And we are the sandwich generation. We are trapped in the middle between elderly parents and our children, all drying us up in terms of energy. So that time poverty can translate into some poor decisions. I'm sure you would have seen that with your investors as well. What are some of the things that you can suggest to people who are feeling time poor?
Yeah, sure. It's not an uncommon model, but I'm going to share this model anyway. It's a time management system. I just highlight a couple of thoughts. You would have seen this, Louise, I'm sure, but the model is very, very simple.
So with this as well, just just with our Talking Trading listeners on audio, just know that you can go over to youtube.com/trading game and see everything on video. It'll make it so much easier. And Brendan's going to describe this very carefully for our audio listeners, but just know you can watch it on YouTube also.
Sweet. So there are two components that drive us in our activity. There's important and there's urgent. Now, they're not always the same thing. And it's important for us to identify that which we feel obligated or drawn to do. So think of the next task you're taking on. We'll keep it at that next task. Think of the next task. Is it important to you? Is it urgent to you? All right. So what do I do with it? All right. So here's an exercise. Again, there's a guy named Brian Tracy. He's very, very good at this. He's explained it very, very well. And there's a 2-step model here, which I'm about to go through, which is a representation of what he's done. Yeah. So not mine, not stealing it, sharing it. Got it. All right. So if you prioritize it, in order for you to have a sense of time in your life, given that we are already full and we're the sandwich generation, how do we create a sense of time? How do we create a sense of peace around our own time management? And the answer is we need to look at everything that we do in our lives. So if you take a moment to sit there with a piece of butcher paper, flip chart paper and a small pen, and you just write down everything that you have to do, just do a massive brain dump. Anything that's going on in my head right now that's cluttering up my mind, that's making me feel overwhelmed and stressed and anxious about all the things I haven't done and all the things I have to do and all of the things that are just in my face right now, get them down on paper. Right. For each one, once they're down on paper, I encourage you just to take a coffee and just go and breathe and relax a bit and come back to it with a fresh mind. Great. Once you come back to your piece of paper and you've got your list, you basically need to put down each of those items in one of these 4 categories. Is it important to you? So there it is. Is it important to you? Is it urgent to you? So there are 4 categories. It's either important and not urgent. It's not important or not urgent. It's not important or it is urgent, or it's important and it's urgent. Yeah. So which one is it? If it's not important to you and it's not urgent, stick it in the bin. Seriously, just put a pen through it and don't even think about it again. If it's cluttering you up, it's those things that are not really urgent that you have to get around to doing. They're not really important to me, but if somebody said I have to get around doing it, I'll keep it in the back of my mind. No, you don't spend the energy on it. Put a line through it, bin it, don't look at it again, because one of 2 things will occur. It'll either become important or it'll become urgent. Either way, don't deal with it now. Bin it. All right, great. If it's not important to you, but it is urgent, yeah? I want you to think about this. If it's not important to you, but it's urgent, then who's it important to? If it's not important to you, but you're feeling a sense of urgency about doing this, then it's important to somebody else. The answer, delegate it back to them. You know what? My life is full. Appreciate this is a real ambition for you. Appreciate this is important for you. Don't want to let you down. Here, take this back. You'll need to give it to somebody else. I can't do it. Yeah? It's not important to you to do. Don't do it. Yeah? And by that alone, you've already eliminated up to 50% of the tasks that are in your face right now. All right. If it is important to you, but it's not urgent, oh, I'm retiring in 5 years. What am I going to do? Plan over a period of time, plan to address it. Stick it in an electronic calendar with alarms. Yep, and that way it'll alarm you. You don't need to hold on to it then. It's out there in the world. It's real. It's an electronic calendar that goes, think of me now. Think of me now. Yeah, great. But you don't have to wear that all the way through. So then you leave it. You're extricating that from the mental burden that you're wearing. All right. That leads us to the last category, that which is important to you and that which is urgent. If it is important and urgent, then you need to prioritize it. We need to do these tasks We need to not think about anything else. We bin the ones that are not important and not urgent. We delegate back all the not important stuff, but other people think it is important. We've already put all of our things for the future in the calendar to give us alarms when we want to address it. We just need to focus now on that which is important and urgent to us today. Right. So what we do then is we take all of those items on your list and we rank them in our mind in order of most important and most urgent. Yep. 1, most important. 2, next most important or most urgent. 3, 4, 5, 6. And then if your list is longer than 6, simply stick the rest in a calendar. Stick it on a piece of paper so you're not wearing it. Oh, I said that was important. I said that was important. I said that was important. What do I do? It's all important. No. Plan for it. Yeah? Only ever take on 6 at the start of a day. The answer is start with number 1. When you wake up in the morning or before you go to bed at night, look at 1 to 6. Recognize that 1's what you're going to wake up and start doing. Wake up. Wrong words. Poo, shower and shave. Get yourself in order and then start dressing number 1. And what you're doing is you are actually attacking that which is the most important and the most urgent for you, and the sense of accomplishment and efficiency that you'll get out of your day if you persist with this is phenomenal. And suddenly you will have a sense of peace and time. Suddenly you'll see that there is latitude in your life for all the things that are important to you. There is space in your world for the things which mean something to you because you've made it a priority and you've managed your time around it. That is which is here for you and you have to live through way too hard. Yeah? Put it aside, plan for it, pick the 2 fingers that are important and then start focusing on those. And that will lift you.
That was so delicious. Brendan, you've got me thinking. You really have. Honestly, I've just identified part of exactly what you're saying that summons my inner lunatic. I have got a finely tuned inner lunatic, and I've recently been able to give it a voice and also give it a body. Now, I'm going to tell you, right, because I haven't shared this with you, but my inner lunatic sounds like that guy from Alien where he says, game over, man, game over. Right? So imagine that, but combined with one of those things out the front of a car yard, those blowy things that are really like waving in the wind. And imagine like, oh my God, you didn't put a stop loss on. Put a stop loss on, Louise, etc. But imagine every aspect that my inner lunatic could talk about in my head while I'm even having this conversation with you. I do find that planning and the delegating, that is my rescue. So I even delegate my housework because that is something that is really, it is important, but it's not urgent. And in some ways it is urgent because it can pile up.
Well, so and you can make it urgent by letting it go.
That's it. That's it. I can get rid of that to somebody else's list, which I love. I could talk to you all day, Brendan, but we are going to wrap up with this because I know you do have other things that you need to do, and so do our Talking Trading listeners. I always suggest that people trade as well as invest in property. Your thoughts?
I can see, I was thinking about this quite a bit. There is value in trading, absolutely, because if you've got smaller amounts of cash, because property is fairly capital intensive, if you've got smaller amounts of cash and you can't buy a property just yet, by all means, trade in order to build your skills to be able to, A, get an investing mindset, B, build up your equity and your capital in order to be able to go into the property as a model. Yeah. So yes, absolutely. For those people starting out with a limited amount of funds, by all means, learn. There is a very, very different set of skills though associated with doing property and doing trades. And there are bits of that do not cross. You can't pick up holus bolus all of your trading knowledge and go, suddenly I'm going to go and buy and make a packet out of property. Not going to work. And flip the other way around. You can't take if you're a skilled property investor, you can't suddenly go into shares and just go, I'm going to be awesome at that. There are skill variances that you'll need to accommodate. However, we need property. People need a roof over their head. when you've got large sums of money, there is potentially, unless you really know what you're doing, when you've got large sums of money, there's potentially a little more risk in shares because for wild fluctuations, less risk in property for wild fluctuations. So it might be better to park mass amounts of money into property for a longer term growth or for the passive income that you want. Again, the answer to me though is it doesn't matter what you pick. Just be an expert in what you do pick. Yeah, sure, you can do both. I agree. Different sets of skills. You have to cross a couple of bridges to make that work. But in order for you to be the wealth that you want in your world, you really need to be an expert in one. Just build your skills on that. And when your skills are so supreme on that, then by all means, learn something else. Don't try and learn both simultaneously. You trip yourself up. You get confused. You can't take on too much. It's the whole priority thing that we just talked about. Pick one that you want to be great at first, learn that, be an expert in that, and then expand. Would be a suggestion. Now, it's a roundabout way of answering your question, but it's kind of the perspective I have around it.
I like it. So how can people stay in touch with you?
Yeah, sure. So to be in touch with me, there is two ways really. Just you can email me if you want to, mentor@resultsmentoring.com. It'll get to me. Or go to resultsmentoring.com. I had a big list. No, I didn't have a big list. I had a little bit of a list. Yeah, just go to the website, resultsmentoring.com, and register for the emails that come out. But if you wanted to get in touch with me personally, yes, mentor@resultsmentoring.com.
Awesome. Brendan, you have been a superb guest. Thanks for playing along today on Talking Trading. I'm so glad we got to show people where the money is in today's market. So make sure that you tune in for the very next episode of Talking Trading, where I'm going to talk to another fascinating guest. And until that time, happy trading.